Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents Wall Street doesn't want you to read. Today, we're cracking open NELNET's annual report, and let me tell you, it's a mixed bag, kind of like that forgotten candy at the bottom of your Halloween bucket. There's some sweet stuff, but also some things you might want to spit out. First, a quick disclaimer, everything we're about to discuss includes forward-looking statements, which are basically corporate crystal ball gazing. They might be right, they might be hilariously wrong, so keep that in mind. NELNET at its core is a company deeply involved in the world of education. Think student loans, payment processing for schools, and even tech services for managing campuses. But they're trying to diversify, dabbling in things like fiber optic internet and even solar energy. To understand NELNET, it's important to know how they break down their business. They've got four main areas: loan servicing, which handles all those student loans; education technology, providing software and payment solutions for schools; asset generation and management, which deals with buying and managing different kinds of loans; and finally, NELNET Bank, their own online bank focused on student and consumer loans. The biggest breadwinner here is servicing those federally owned student loans. They're basically the middleman between the government and millions of borrowers. But this segment's revenues are heavily dependent on government contracts, making it vulnerable to policy changes. Speaking of government, in early 2023, NELNET snagged another contract from the Department of Education to continue servicing student loans, but there's a catch, because the way they get paid is changing, and it might mean less revenue per borrower. To counteract this, they're aggressively moving into the private education and consumer loan servicing market, which is a whole different ballgame with its own risks and rewards. This segment is about providing technology and services for schools, from K-12 all the way up to higher education and even churches and businesses. They're the folks behind FACTS, which handles tuition payments and financial aid for tons of private schools. FACTS alone generated $308 million in revenue in 2024. They also operate NELNET Campus Commerce, focusing on higher education, and NELNET Payment Services, which supports secure payment processing. This division was formally established to really maximize the returns from their existing student loan portfolio, while branching out into new kinds of lending. They also own pieces of securitizations, which are bundles of loans packaged up and sold to investors. The company's partial ownership percentage in each loan securitization grants the company the right to receive the corresponding percentage of cash flows generated by the securitization. NELNET Bank offers refinance options for private education loans, along with in-school loans and even some unsecured consumer loans. Basically, they're trying to become a full-fledged consumer lender, but online. One of the segments here has been leveraging its capital through multiple reinsurance treaties, essentially betting on other insurance companies. They're essentially insuring insurance companies, which sounds safe but can get complicated quickly. The company also puts money into real estate, with over 45 investments across the US, the majority of which involve commercial properties. And of course, as with any business involved in physical assets, they're keeping an eye on climate change and its potential impact. ALLO is where things get interesting. Remember that fiber internet company? NELNET still has a sizable stake in it, even after a recapitalization a few years back. ALLO is actively building out its fiber network in several states, and actually generated approximately $190 million in revenue in 2024, but it's also carrying a hefty amount of debt, around $1.14 billion. So it's a high-growth, high-risk play. The other major investment arm for the company is venture capital. The company has investments in approximately 75 entities and approximately 35 funds, and the total carrying value of such investments was $289.1 million. One of their biggest bets here is on Huddle, the sports video analysis platform, which the investment carrying value of approximately $168.7 million. Data security is a major theme. As a loan servicer and tech provider, they handle tons of sensitive personal information. A breach could be devastating, both financially and reputationally. Looking at the people side of the equation, they've got roughly 6,700 employees. The company is organized with NDS loan servicing, comprising the majority of its employee resources. They're actively trying to attract and retain talent, especially in the tech space. And for all the hiring they have done, they seem to be doing well, with the average employee has roughly 8 years of tenure at the company. Now, let's dive into some numbers. In terms of stock repurchases, they bought back a small amount of shares, about 41.45, at an average price of $108.33, although there is capacity to continue increasing its share repurchase program. Okay, let's talk financials, the nitty-gritty. Jumping over to their income statement, and as a diversified company, you see contributions from LSS, NBS, and even non-operating activities such as ALLO and venture capital. GAAP net income attributable to NELNET Inc. increased sharply, almost doubling. That being said, their preferred non-GAAP income was a drop at approximately $176 million from $121 million due to mark-to-market accounting adjustments. Drilling down, the education technology segment saw a substantial 3.7% increase as revenue for their fax product saw revenue of $308 million. This comes at a time when the company has had to manage losses from legacy construction projects that still affect operations. Net interest income took a hit, though, as their existing FFELP student loan portfolio continues to shrink. That affects net interest income. They actively acquiring loans to reposition themselves for a post-FFELP world, but this will be no easy feat to replicate. Looking at the remaining NFS segments, WCRM reported management fees of approximately $5.6 million, and the insurance segment recognized $62.9 million from premium revenue from existing insurance programs. They've got a decent chunk of change on hand, around $717 million in unencumbered cash and investments. Plus, they have that line of credit for another $495 million, so they're not exactly strapped for cash. One thing to keep in mind, the U.S. Department of Education is their biggest customer for the loan servicing segment, representing 26% of their revenue. That's a lot of eggs in one basket. If they fumble the servicing requirements or the government changes the rules of the game, that could really hurt their bottom line. Those solar investments we talked about earlier, they rely heavily on government incentives, and those could change at any moment, putting those investments at risk, as tax credits from the solar projects remain subject to recapture from tax authorities. They admit that their technology infrastructure is vulnerable to cyber attacks, and a breach could be devastating and lead to a loss of confidence from government clients and other customers, legal liability and reputational harm, and adversely impact our business, financial condition, results of operations, and prospects. Additionally, with increased use of AI tools, this exposes a greater surface area of data that might be vulnerable, which could result in regulatory action, loss of confidence from government clients and other customers, legal liability, and reputational harm. One last thing to consider. Michael Dunlap, the executive chairman, controls a whopping 80.6% of the voting power. He basically calls all the shots, which could be good or bad depending on how you feel about his decisions. Also, if you ever wanted to sue them, you might have to do it in Nebraska. Their corporate charter requires certain lawsuits to be held in Nebraska courts, and that would limit investors from bringing lawsuits where they feel they're most likely to win. So what's the verdict on NELNET? Well, they're definitely trying to transform themselves. They are proactively looking to maximize their return and diversify their assets. But they're walking a tightrope, balancing the stability of government contracts with the riskier but potentially more lucrative world of consumer lending and investments, which may or may not pay off. Overall, given how diversified their interests are, ranging from loan servicing to communication to solar tax equity investments, the company has various surface areas of risk. That being said, with a carrying amount in HUDL with zero fair value and preferred membership in ALLO, in which they earn preferred returns, you might be missing out if you value this company at solely the book value. Thanks for tuning in to Corporate Decoder. If you enjoyed this deep dive, give us a like, drop a comment, and subscribe for more explorations into the hidden corners of corporate finance.